All right, let's talk about DMart. You know them, right? One of India's most successful, most profitable retail chains. But what's really fascinating here isn't just about selling groceries cheap. No, this story is a masterclass in how a very specific, very powerful way of thinking about investing can build a retail empire from the ground up. So you gotta ask yourself, how does an abstract idea for picking stocks actually turn into a real-world business? You know, the nitty-gritty of stocking shelves, running warehouses, and getting millions of people to walk through your doors. Well, that's the story we're gonna unpack right now. Okay, so to really get what DMart is all about, you first have to understand the mind behind it. And he's a bit of a legend, a famously media-shy guy who's also one of the most respected investors in all of India. Meet Radhakishan Damani. Now, before he ever became a retail king, he was already a legend on the stock market, and he still is. He started Avenue Supermarts, the company behind DMart, way back in 2000. But the real genius here, the blueprint for the entire company, wasn't new. It was based on the exact same rules he'd been using for decades to pick winning stocks. And that brings us to his playbook. It's a classic, time-tested strategy, but here's the kicker. Damani didn't just use it for stocks. He applied it to literally everything in his retail business, every single brick, every product, and every process. So what is this philosophy? Well, at its core, it's value investing. And the idea is actually pretty simple, but it's also incredibly powerful. It's all about finding something great that the market, for whatever reason, is underappreciating. You buy it for less than it's really worth, and then you just wait. It's about finding real, solid value, not chasing the latest hype. This whole philosophy has a few core rules. And what's so wild is that these aren't just for Wall Street types. Damani used these exact same principles to build DMart. Now, I want you to really lock in on that second one. Insist on a margin of safety. Seriously, that one phrase, it is the key to everything. So how in the world do you build a margin of safety into a physical business like a supermarket? Well, you start by building a fortress. You get an iron grip on your biggest costs, and you make decisions that are going to pay off for decades, not just next quarter. And there is no better example of this than their real estate strategy. While all their competitors, like Big Bazaar, were leasing expensive spots in fancy city centers, DMart went the other way. Damani just applied his value investing playbook. He bought the land. By owning its stores or getting into these crazy long 30-year leases, DMart completely eliminated a huge, unpredictable cost that ended up crippling its rivals. And the scale of this advantage is just massive. I mean, that one decision to own rather than rent can save them between 5 and 10% of their total revenue. That's a huge margin of safety baked right into the business model. And where do those savings go? Straight to you, the customer. So this all starts to build on itself, you know? It creates this absolutely unstoppable efficiency engine. That philosophy of long-term value, it starts with the real estate, but it extends to every single part of how they run their stores. And all of that efficiency, all of that long-term thinking, it all boils down to this one simple, powerful promise. It's not about flashy sales or temporary promotions. It's about reliable, consistent value. This is that intrinsic value principle, but applied to your shopping cart. And the results? Well, they speak for themselves. This chart shows revenue per square foot, which is a super important metric in retail. Yeah, you can see that little dip there during the pandemic, but just look at that consistent high performance before and the strong recovery after. They squeeze more value out of every inch of their stores than anyone else. It's not even close. And that insane efficiency translates directly to the bottom line. Get this. Even though Reliance Retail is 6 times larger in terms of revenue, DMart is nearly 3 times more profitable on a margin basis. That is an incredible testament to their focused, value-driven model. Okay, here's another move that is pure contrarian genius. Most retailers, they delay payments to suppliers to help their own cash flow. It's standard to pay in 45 or 60 days, but DMart does the exact opposite. They pay their vendors in about a week. Why would they do that? Because it builds immense trust. Suppliers love them, which means they give DMart their absolute best prices. It's a classic long-term win over a short-term gain. But of course, no business is invincible. After years of what seemed like flawless execution, the fortress that Damani built is now facing some pretty significant pressures from the outside world. The whole economic environment has shifted. Inflation is pinching everyone's household budget, right? And that's leading to a slowdown in sales of the higher margin stuff like apparel and home goods. At the very same time, competition is heating up, with giants like Reliance and others aggressively expanding into DMart's backyard. And you can see the impact pretty clearly in the data. This chart shows what's called like-for-like growth. It's basically how much sales are growing in the stores that are already open. And after that huge rebound post-COVID, you can see the trend has really cooled off. It's a signal that the easy growth phase might be hitting a few bumps in the road. Which brings us to the final and maybe the most important question, especially if you're an investor. The whole market knows how great DMart is. The secret is out. So has the price of the stock itself forgotten the very philosophy that built the company? Right now, DMart's stock trades at a price-to-earnings ratio of around 90. To put that in perspective, that is an extremely high valuation. It means investors are expecting massive, perfect growth for years and years to come. It's a price that has perfection already baked in. And the professional analysts are taking note. This report from HDFC Securities pretty much highlights the whole problem. They're saying, look, we get it. The business is amazing, but the price is just too high. The risk-reward just doesn't look good at these levels. And this brings our entire story full circle. Radhakishan Damani built his empire on that one core principle: buying an excellent business at a fair price with a margin of safety. There is absolutely no question that the business is excellent. It's a masterpiece. But for someone looking to invest in it today, the real question remains: at this price, where is the value investor's most crucial tool, the margin of safety?